Good morning, everyone. Clifford Bennett, Chief Economist at ACY Securities. I hope your week's starting with a bit of a spring in your step. It certainly has, there's some first leaves on one of my plants today, so spring is arriving. So let's all celebrate that. Speaking about spring arriving, there's something a little bit different about the price action in New York on Friday, where the stock market really started to fall back in on itself and really overall had quite a heavy day. Now, this is despite all of the positive euphoria around the place at the moment. Do you know anyone who isn't long US equities? That could be the problem. Now, I've said go with the momentum to the upside, and I still think that's the case. I still think the bulls have a technical price argument, while the Dow Jones holds above, say, 34,150 or 34,200. If the Dow Jones moves below that level, it would suggest that perhaps something structurally is changing for the US equity market to the downside. We had some interesting data out in the US on Friday too. We had US consumer sentiment, University of Michigan survey, most reliable on the consumer sentiment front in the United States. And they showed a bit of a bounce, actually, a bit of a lift. And that survey said consumer confidence, the headlines, consumer confidence at a 2-year high. Yet, it's still at below COVID lockdown levels. The US consumer is still more concerned, more worried, more upset, more apprehensive, even depressed perhaps, than they were during the COVID lockdown period. So, and historically, it's only been here at GFC before, or the 80s crisis. So these are still terrible consumer sentiment numbers. But of course, it's nice to see a lift. The other thing that looked good on the monthly data was US import prices, which were down 0.2%. But the decline has been slowing as the US dollar has started to turn around. It takes several months, really, for movements in the US dollar to really start to bite in terms of import prices, reasonably quickly import prices. But by the time it gets to CPI and that sort of thing, it does take several months. This declining US dollar, it does look like a trend, and even if it has a good rally at the moment, I've actually just sold some Euro and Aussie, so there could be a short-term bounce for the US dollar, but overall the economic trend for the US dollar is very much to the downside, and this is going to be a fresh impetus to the inflation numbers at the end of the tunnel there, pipeline. So this would be something that is catching the Federal Reserve's eye, and it will be another reason, if the US dollar keeps declining, why the Fed will be maintaining a tightening bias still for far longer than all the market people who said we were going to pivot a year ago, now telling us, oh yeah, but it'll happen soon. It's never going to happen. It's going to be a plateau in rates for a very long time. And the same could be said about the RBA as well. New RBA governor, what a disaster. Labor's Bill Chalmers has messed it up, and the Liberals were no help either. Again, playing the old boys club, really it is. And keeping the status quo in terms of promoting from within the Reserve Bank. The Reserve Bank review, an OECD urgent inquiry, found the Charter and the RBA board needed reconsideration. Their own independent review found alarming weaknesses in the Reserve Bank. And yet still, they're going to appoint someone who is just typical of that antiquated, out-of-touch institution. Big mistake. I've been saying for 10 years, seriously I have, it's probably 12 years, we need governors of the RBA to be appointed from outside the bank, instead of this just say yes for your whole career to the person above you until you become governor, by default. That's what's happened here. Again, a deputy governor, by default, becomes governor. More needs to be done. More needs to be done. We'll see how this goes, but also the big mistake the press is making is saying that it was a hard job for Lowe because he had to hike rates. He only had to hike rates aggressively because he messed it up in the first place by keeping rates near zero for too long. That's the reason he should be thrown out, not because he's hiking rates. So it's an entire misdirection to somehow all get along, fit in, No, a little bit of aggression here and there in getting policy right for the Australian people would be a good idea too. But back to the US stock market. They're not really interlinked, but here we go. Back to the US stock market. Look, that 34,200 level on the down, you'll be able to see similar price action levels in the other indices and various stocks. Just be careful that there isn't some sort of breakdown in price building just here, especially if people realize that there's no interest rate cuts coming at all, not even on the horizon. In fact, there's going to be another one. What if there's another 2 rate hikes if core inflation remains high? So just be aware the surprise could still be to the upside for the US interest rate outlook. If it's either a plateau or higher, that is the scenario for the next 6 to 18 months. That's not what the market's pricing. So I continue to caution, go with the momentum, but if the momentum turns, it could be something very, very significant in terms of downside risk for equity markets. And it's worth keeping a very close eye on this price action over this Monday, Tuesday trading. There was a very heavy close in New York on Friday. If the market starts to break down, it could build momentum. It should try to hang on by its fingertips and climb back up into that range, that immediate range. So let's see how that Monday New York trading goes. But any kind of momentum build to the downside could be something that lasts several months, not hours. I hope you have a great week. Clifford Bennett, Chief Economist, ACY Securities.